risk in Asian equity markets has been declining since September. Why is that, and what factors might put an end to this trend?
Well, we certainly have been seeing risk decline. It's driven to some extent by lower volatility, but importantly, it's also being driven by lower correlations among stocks. So whereas 6 or 12 months ago, stocks were generally moving in the same direction at the same time, we're seeing much more differentiation among stocks in most of Asia right now. We're also seeing more differentiation in countries and how the risk-return trade-off in countries as well. So while some countries like India or Indonesia have become much more volatile and much more risky, other countries have not moved in that same direction, largely driven by the economic characteristics of the individual countries.
So if you think about 6 months ago when the word tapering first was heard, and investors were thinking about the Fed pulling the rug from under their feet, this liquidity rug that has been cushioning the markets for years, and that drove all of the stocks to move in one direction, down. Now they're over this initial shock and they're thinking, okay, tapering is for real, it's going to happen in the next 3 months or 6 months, it doesn't really matter when, but it's going to give rise to a different environment, a higher interest rate environment than we've had for the past 3-4 years. And therefore, we're back to going to visiting companies and finding out how these companies are going to be able to weather that new environment. Which ones are going to outperform, given a higher interest rate environment, and which ones won't. Mm-hmm. And the same is true for countries. So Indonesia and India have some fiscal issues, which might make them more volatile in a higher interest rate environment. Whereas other places like Korea or Taiwan or places with surpluses are not going to be impacted so much by that.
When was the last time that you've seen this very focused attention on individual companies and greater differentiation among markets?
Well, it certainly goes back to before the start of the global financial crisis.
Definitely, yes. I mean, factor risk or systematic risk has been the dominant source of risk since 2008, even since 2007 when the quant kind of crisis started in July, August of 2007. Already there, that was the end of the stock picking boom. And many commentators over the last 5 years have come out with comments that stock picking is dead and so on and so forth. We don't think it is. We just think that the environment was not conducive for stock picking. The risk was just not worth the reward. We're not being rewarded for picking the right stocks because it had nothing to do with market movements. Today it is again.
We've seen allocations to cash and other highly liquid assets on the rise in the recent past. Is this continuing?
So now we're definitely seeing a drop in the amount of cash that people are holding on to. I mean, cash was really there because you can make a forecast in the past couple of years. Even the CEOs of the companies themselves would not give you a forecast during the earnings release past 6 months. There was just no visibility. So cash was the only way to protect yourself. Today we're seeing a lot more visibility. We're seeing more of the companies meeting earnings expectations and providing guidance in line with what analysts had forecast. So we're seeing an environment where there is a lot more visibility into what could happen, and therefore putting that cash back to work is a sensible thing to do.
And from a risk perspective, I think the risk of having too much cash in a rising market is disproportionate to the risk of not having cash in a falling market.
After a year or plus now of risky assets outperforming non-risky assets, what you have now is investors focusing less on the downside risk and protecting themselves from that, and more on the risk of missing the upside potential that there is in the market.
Some of the Asian institutional investors are replacing their allocations to commodities and hedge funds with allocations to real estate and infrastructure on account of risk and returns. Are there any pitfalls with that strategy? Is there anything that these investors should take special note of?
I think in the region, they have been investing in real estate and real assets for some time. And this has been made even more necessary in this low interest rate environment because yields are so low on just about everything else. If you look at traditionally rental yields in Asia have been pretty healthy, 4 or 5% range at least. That's way above what you can get for a financial instrument today. So there is definitely a need for that. There is a need for them to generate income on their huge reserves because of the aging population problem in Asia. So these things have been going on for some time now. They've just been accelerated by this low interest rate environment. But we're starting to see some changes in that, in the sense that equities are making a comeback now, and with returns in the teens or even 20% or 40% like Japan this year, it is attractive, and you have to think about reallocating some of that money to a risky asset.
Okay, thank you very much both.